Hello and welcome to Money Control. My name is Shraddha Sharma and we will be talking about Kotak Mahindra Bank in this segment for ideas for profit. Kotak Mahindra Bank, the country's third largest private sector lender in terms of market cap, is a must buy and to have on any investor's portfolio. While the valuation is at 4 times FY22 estimated core banking book, it looks optically expensive. Investors got to factor in the immense value unlocking opportunity in the various promising subsidiaries of the bank, none listed at this point in time. With the controversy pertaining to promoter stake reduction put to rest thanks to the likely change in ownership guidelines, we see very few roadblocks in the growth journey of Kotak Bank. But in case there is a second wave, it could definitely impact earnings and asset quality. Let's talk about the economic fundamentals. The bank saw a healthy 16.1% year-on-year growth in profit at Rs 1853.5 crore for the third quarter in the current fiscal year, up from Rs 1596 crore in the same corresponding period for FY20. But on a quarter-on-quarter basis, its profit were down by 15%. The net interest income, the difference between interest earned and the interest expended, has grew by 16.83% on year-on-year basis to just over Rs 4,000 crore. In Q3 FY21, it is comparing to Rs 3,429 crore in the same period last year. Advances in Q3 stood at Rs 2,14,103 crore, declining 1.2% compared to Rs 2,16,774 crore on a year-on-year basis, but reported 4.5% sequential growth. Deposits grew by 10.8% on year-on-year and by 1.4% quarter-on-quarter to Rs 2,65,304 crore in Q3 FY21. There was a substantial jump in provision as the bank has adequately recognized and provided for stress and slippage. Liability, the best in the industry. The bank now boasts of an industry-leading CASA, that is low-cost current and savings account ratio of close to 59%, despite cost of savings deposit having fallen steadily to 3.8% from 5.3% in the year-ago period. The low-cost deposit has grown much faster, both sequentially as well as year-on-year. The share of stable granular deposit is close to 92%. Also, we must not forget that the combined attractiveness of the conglomerate with promising business across financial services puts the bank in a vantage position as it stands to gain significantly from financialization of savings. Going overdrive on recognizing possible stress. Well, despite the Supreme Court ruling that barred banks from recognizing NPA after August 2020, the bank has taken a prudent decision and has disclosed that it has recognized the slippage. Its gross and net NPA would have been 3.27% and 1.24% instead of the reported 2.26% and 0.5% respectively. The bank has made provision for the interest reversal on this slippage. It also carries COVID provision to the tune of Rs 1279 crore, that is 0.6% of net advances. The provision cover, that is provision on gross non-performing assets on pro forma NPA, stands at about 63%, although the reported provision cover is 78%. The bank has done restructuring to the tune of 0.28% of net advances and has seen a slight deterioration in its special mention accounts, that is principal and interest overdue between 61 to 90 days. That has touched 31 basis points of advances from the previous 6 basis points in the previous quarter. Overall, we recommend that this is a must-own portfolio stock which will deliver steady returns backed by a predictable earnings growth.